Ladies and gentlemen, this is Sri from Full Futures. Welcome to the live webinar. Today we're going to be talking about something really exciting is the question on everyone's lips. How high will the US index go? We have seen quite a bit of, the trade tensions have actually slowed down quite a bit in recent times with temporal easing, and the indices are still rallying to new high points in first few high points noticed in the year, and it seems to be pushing higher than before. With us today to tell us more about the U.S. market fundamentals, recent developments in the trade tensions, the Fed's interest rate policy, and anything else associated with the US index is none other than our special guest, Eric Nolan, the senior economist and executive director for CME Group. I believe I've attended a handful of Eric's webinars and seminars, and every time I've been uh, completely enlightened by his views. He presents views that can be very different, very insightful, and all in all, I think is ultimately very useful. For CME Group, he is tasked with identifying emerging trends, evaluating economic factors, and forecasting their impact on CME Group and the company's business strategy. So I'm pleased to have Eric Nolan in the studio with us today. Without further ado, before I hand the reins over to Eric, rather, I just want to check with the audience. Can you hear me loud and clear? If you can, please type your response in the question box. At any point in time during the webinar, if you have a query, feel free to type them in the question box. Thank you, Shofang, Jane Go, Edmund Che. Thank you so much. At any point in time, please type your questions in there, and we'll pick them out as we go on or whenever there's a break in the webinar. And yes, I believe this is your cue, Eric. Over to you.
All right. Well, thank you so much to everybody at Phillips for inviting me back to talk about the state of the equity markets and how they relate to the global economy, as well as to my colleague Rachel Wong in our Singapore office, who also helped to coordinate this event, which will hopefully be fun and insightful for everybody. Before we get into the details of the event, I am required to show you both the short version of our disclaimer, which you see right here, which basically says that because CME Group is an exchange and not a broker-dealer or an investment bank, we are unable to give you any financial advice. So we will be trying to make this as two-sided as possible, giving you both a sense of the upside as well as the downside risk for various markets. The second version of the disclaimer basically spells out a lot about who our subsidiaries are, and it basically says that this is really just being provided for educational purposes. So with that in mind, we have the equity markets, for the most part, trading at a record high. The NASDAQ, of course, has been the big leader since this bull market began on March 9th, 2009. So, over 10 and a half years ago now, a little bit over 10 and a half years. And it's been a spectacular bull market. We have the NASDAQ up 700%. From its low on March 9, 2009. The S&P 500, up about 350%, up about the same amount as the Russell 2000, which of course is an index of small cap stocks. The NASDAQ has been the big outperformer, as we'll discuss later in the presentation, mainly because it's very technology heavy. So when we go down and look into the details a little bit more in terms of industry groups, we'll really see the dominance of the NASDAQ from that perspective. What is also interesting, I think, to point out is that the Russell 2000, even though it's done very well since 2009, it is not trading at a record high. Small cap stocks have begun to lag. Small cap stocks peaked out sometime at around sort of mid 2018, and since then are actually off their highs, which is a big contrast to the Nasdaq and to the S&P 500, both of which are continuing their rallies towards record highs. when it comes to the future of the market, I think it's interesting to contrast what the equity market believes about the future, which is evidently very optimistic, with what the fixed income market seems to believe about the future, which is substantially less positive. If you look, for example, at Fed funds, the Federal Reserve has now cut interest rates 3 times, which explains to some extent, of course, why stocks have been doing so well. But if you look at the short end of the U.S. yield curve, basically it thinks in 1 or 2 years' time, interest rates will actually be lower than they are today, which suggests that the fixed income markets are not so positive about the direction of economic activity. They seem to think that maybe we even have a slowdown coming, which of course is a very stark contrast to the beliefs of the equity market. Since the Federal Reserve has begun to cut, these markets have depriced some of their expectations. If you look at their expectations from about 2 or 3 months ago, you see at that time the markets were expecting the Fed might even cut maybe to 50 or 75 basis points below where they are today. The market now thinks that's come down to 1 cut. So essentially, when you look at these two markets side by side, this is what you see. You see a very positive equity market that's heading towards record highs, and a fixed income market that's really not so sure that everything is okay. And so in the end, only one of these two markets can prove to be correct in its economic understanding. In some ways, this sort of reminds me of a situation that we saw 21 years ago, back in 1998. So back in 1998, the Federal Reserve also cut interest rates 3 times in the aftermath of Russia's default on its debt and the subsequent meltdown of the American hedge fund called Long-Term Capital Management. So after the Fed cut 3 times between August and October 1998, the equity market soared. The Nasdaq went up 99% over the next 15 months before it finally peaked out in early 2000. The S&P 500 rallied 50% during that time, and eventually the fixed income markets had to deprice their expectations that the Fed was going to cut further and begin pricing in expectations that the Fed was going to raise rates. And indeed, in 1999, the Fed actually began raising rates again. They raised rates about 175 basis points, and that was what finally did end the equity rally of the 1990s. It was those last set of rate hikes in 1999 and 2000 that not only ended the bull market, but also put the U.S. economy into a recession. So that's possible. We could see this equity market, with the S&P currently trading around 3,100, potentially going much, much higher, in which case the fixed income market could really no longer continue to expect that the Fed is going to actually be cutting rates. It may actually have to begin to price in the possibility that the Fed might be lifting rates a bit higher sometime next year or the year after. So that's one possibility. The other possibility, though, is we have a more near-term correction where the equity market loses momentum and starts selling off again, in which case it would justify the fixed income market's rather pessimistic view of the economy. And this, of course, leads us to the question of why is it that the Federal Reserve has been raising rates in the first place? And the answer to that question is the Federal Reserve has models of how the U.S. economy works. And one of those models includes a variable that they call U star. And U star is actually not directly measurable, so they can only measure it sort of indirectly. And U star is basically the non-accelerating inflation rate of unemployment. The Federal Reserve thinks it's somewhere between 4.1 and 4.7%. So let's say 4.4% on average. But as you can see, unemployment's been below this range now for a very, very long time. It's been below this range really for over 2 years now, and we've seen unemployment rates as low as 3.5%. I think currently it's at 3.6%. And in any case, we've seen no pickup in inflation. So the Federal Reserve raised rates because they were concerned that falling employment would boost wages so much that it would outstrip productivity growth and start causing inflation. So they felt like they had to get ahead of that curve by raising interest rates. The problem with this whole scenario, though, is we've actually not really seen very much in the way of actual wage growth. If you look at wages, they're still growing at something like 2.9% year on year. Productivity is growing at around 1.5% to 2% or so. That leaves very, very little inflationary pressure. So I think the Fed is reevaluating now. They're cutting rates back a little bit, and that could be phenomenally good news for the stock market. If we are really in this Goldilocks scenario where unemployment rates can continue to fall or in any case remain very, very low with no inflation, then the stock market could potentially continue to go much, much higher. That's certainly one possibility. But there are things to be concerned about. And so one of the things that concerns me the most is when you look at GDP growth is actually beginning to slow a fair amount. When you look at U.S. GDP, it had been growing at about 3% pace in 2018, and we've now slowed down to about a 2% pace. In addition to that, many, many other economies are showing slower growth, including the United Kingdom and Japan. But when it comes to the U.S., what particularly concerns me is it looks like the U.S. economy is probably in for a somewhat deeper slowdown. One of the really great indicators of where the economy is going in a few months' time is to take the ratio of the leading economic indicators and divide it by the lagging economic indicators. So the leading indicators, I think, include 7 or so different variables, things like building permits for new houses, the shape of the yield curve, the state of the equity market, et cetera. Where the lagging indicators tend to look at things that are sort of trailing indicators of where the economy has been, things like the duration of unemployment, et cetera. And this ratio is showing that the U.S. economy looks like it's getting ready to slow down from its 2% pace of growth, maybe to more like a 1% pace of growth in 2020. And if that's right, it's not going to be very good news for earnings, which would be bad for the stock market. On the other hand, it might justify more Fed rate cuts, which could potentially be good for the stock market. So slower growth in some ways is a double-edged sword. On the one hand, it makes equities look less attractive because growth isn't as strong. On the other hand, the market in theory is supposed to be discounting the value of future earnings back into the present. So if slower growth causes interest rates to fall, the discount rate essentially falls, which boosts the value of those future earnings and dividends, potentially sending stock markets higher even in the face of a slowing economy. The other thing I would point out is that this ratio is not yet pointing towards an economic recession. Now, that could be the case if this ratio continues to worsen, but for the moment, it's pointing towards a sort of soft landing or a slowdown and not a recession on the immediate horizon. But what's also concerning, though, is it's not just the U.S. slowing. So we already looked at Japan and the United Kingdom, which are clearly slowing. Also, the Eurozone and Sweden showing very, very weak economic growth. That's true throughout almost all of Europe. China also slowing down quite considerably as well. When you look at the official Chinese GDP, is showing still 6% growth, which admittedly, by the standards of most economies, is extremely impressive growth. But that growth rate's coming down. And unofficial measures also show some slowing of the Chinese economy. China's economy, of course, has been negatively impacted, as I think has the U.S. economy, by the trade war. I think the trade war in some ways is maybe a little bit exaggerated, but it was worth bearing at least a brief mention to it. Essentially in May last year, May 2018, President Trump imposed a 10% tariff on $200 billion worth of Chinese goods. That's essentially a $20 billion tax. And so the Trump administration seems to believe that China pays all of this tax, which of course is not true. The tax is actually a tax on American consumers and American businesses who buy goods from China. So implicitly, China does pay a portion of the tax through reduced export margins and reduced export volumes to the United States, where the rest of it is picked up by U.S. consumers. Since then, the tariffs have gone considerably higher. On September 1, they rose to 25% on those $200 billion worth of goods. And at least in theory, there could be an additional 10% tariff on $300 billion of additional goods. It's a little hard to say because not all of those tariffs have come into effect. Some of them have been delayed. But in a sort of worst case scenario, this $20 billion tax suddenly becomes an $80 billion tax, which I think uh, begins to have a more negative impact. Um, and if you do the mathematics of this, what we can see um, is that the current level of tariffs, the $20 billion, probably reduced China's GDP growth rate by just about 1/10 of 1%. Where it probably raised U.S. consumer prices by maybe 5/100ths of 1%, so not even 1/10 of 1%, probably lowered U.S. corporate profits by about 0.6%. If you add in all of the additional tariffs that have or may come into effect, that could take U.S. consumer prices a couple tenths of 1% higher, maybe knock 2 to 2.5% off of U.S. corporate earnings, and also slow China's economy by a further 0.5% or so. So this obviously hasn't been very good news. I think in some ways it's not great news for the U.S. equity market because it's also caused the U.S. dollar to strengthen. So normally when a currency strengthens, that's somewhat bearish for the equity market. So the equity markets have, of course, continued to go higher since this trade war came into effect. But as we'll talk about in a minute, as they have gone higher, volatility has tended to increase over time. And so China has been offsetting some of the negative impact of this by allowing their currency to depreciate. So, for example, you see that when the 10% tariff went into effect, China's currency slid by 9%. Then, as the U.S. threatened to raise tariffs higher, Chinese currency has continued to fall. But what's even more striking is that other emerging market currencies like Russia, India, Brazil, their currencies have weakened a considerable amount more, which is making the U.S. less competitive. U.S. dollar, as we'll talk about later on, has been a very strong currency, and that's also probably going to hold back U.S. equity markets a little bit. But I think really the biggest concern for all of these markets is the level of debt, the level of debt in China, but also in Western countries like the United States itself. So you can see one of the most striking things about this chart is that the United States, the Euro area, and the United Kingdom never really delevered their non-financial sectors after the financial crisis in 2008. The levels of leverage in those countries remain very, very high outside of the banking systems. The banking systems did delever, so the banks are not as heavily exposed today as they were 11 years ago, but the levels of debt in those countries are still very high. What is very striking, however, is that China has caught up with them in terms of debt levels. And I think that this is really bearish for China's growth going forward. The combination of high debt along with demographic changes, in addition to the trade war, I think will continue to slow China's growth in the 2020s. And I think that will be particularly negative for certain categories of stocks, most especially energy stocks and stocks that deal with metals mining, or what we call material stocks. The other thing I think is really striking about the Fed's decision to raise rates all of these times is that there's really no relationship at all between the level of unemployment and the level of inflation. So the Fed raised rates a whole bunch of times, but if you look at the Phillips curve, it's really more like a Phillips pancake. There really is no relationship between the level of interest rates and the level of unemployment, or should I say the level of inflation and the level of unemployment. Hopefully, the Federal Reserve will sort of take this into account and allow monetary policy to ease further and allow the economy to continue to grow. But the Federal Reserve for the moment seems to be taking a very stubborn line that it cut interest rates a few times and now it's at a perfect level of interest rates. And it's at the right level going forward. I don't think that's true. I think that the Fed is still very, very much too tight and really needs to ease policy further. Part of the reason why I think that is this very strange relationship that we see between the level of interest rates and the level of volatility in the market. And I think this is really poorly understood. But on this chart, what you see is you see the level of the VIX index, which is the index of options on the S&P 500. So the VIX index basically has two states. It has a very high volatility state, like it had at the end of the 1980s and early 1990s, from 1997 until 2003, and from 2007 to 2011. And in these high vol states, the VIX can average, even a 2-year moving average, it can average like over 25, even over 30%. During its low volatility states, like it was in the mid 90s and mid 2000s, and since 2011, volatility can average as low as about 12%. In the last 2 years, it's averaged around 14% implied volatility. So really extremely low implied volatility in the equity markets. But there's a certain pattern to this that deals a lot with U.S. monetary policy. So in this chart, on the lower axis, you have what we looked at the previous chart, which is basically this 2-year moving average of the VIX index. On the other axis, on the y-axis, you have the easiness or the tightness of monetary policy. So if you're up at the top of the graph, you have a steep yield curve, which means easy money. And if you're down at the bottom of the chart, you have a flat yield curve, which means tight money. If you're over to the left-hand side of the chart, you're in a period of low volatility. And if you're at the right side of the chart, you've been in a period of high volatility. So if you look at, say, 1990, 1991, high volatility, very flat yield curve. So what happened? Well, first of all, the U.S. economy went into a recession. The combination of tight money plus volatile markets cut off the flow of capital to businesses. So we saw an explosion of credit spreads. Junk bond markets collapsed. Drexel Burnham Lambert, which was the inventor of junk bonds, actually went bankrupt. And big banks like Chase Manhattan and Citibank found themselves in very severe financial trouble, as did hundreds of smaller savings and loan institutions. So the Federal Reserve responded to this recession by cutting interest rates. And as they cut interest rates in 1990, 91, and 92, the yield curve steepened a great deal. And those lower interest rates and a steeper yield curve injected a great deal of money into the financial markets. And when there's a great deal of money in markets, it makes it very easy for buyers to find sellers and sellers to find buyers. And when they find each other easily, somebody can execute a gigantic order in the marketplace, and there will be somebody there to take the other side of that trade. So prices don't have to move very far in order to fill orders. So what happens typically in steep yield curve environments is that volatility falls to very low levels, which is indeed what had happened by 1993 and 1994. So then the Federal Reserve decided, okay, it's safe. The economy is recovering. Volatility is very low. We can go ahead and begin to increase interest rates. So as they did that, the yield curve flattened a great deal. And then in 1996, we had this fascinating year. It was a year in which the yield curve was very flat and equity markets were soaring anyway. Alan Greenspan, at that time, the chairman of the Federal Reserve, at the end of 1996, described this as irrational exuberance, which I think was a sort of cry of frustration. He was frustrated that he had raised interest rates so much, and yet the equity market was still soaring. It wasn't really responding to what he thought was a tightening of monetary conditions. But that tightening of monetary conditions became more and more evident as the decade went on. And the way in which it evidenced itself was a rise in volatility that was sparked first by an emerging market currency crisis that, of course, began in Asia and Thailand in 1997, quickly spread through the Pacific Rim, and then in 1998, of course, it spread to Russia, long-term capital management. So by the end of that decade, we had markets that were becoming more and more volatile. The equity market was still soaring right up until the year 2000. But in the year 2000, with that flat yield curve and high volatility, equities began to crash. The S&P fell 50% over the next 2 years. The NASDAQ index, which had dominated the rally, much like it has in the last few years, fell 85%. And as that happened, we wound up with a much steeper yield curve as the Federal Reserve slashed interest rates to 1%. That had its usual impact, which was to reduce market volatility. As market volatility fell, eventually the Federal Reserve began to increase interest rates. As they increased interest rates, once again, we had a flat yield curve, and for a while in 2006 and early 2007, a flat yield curve plus extremely low volatility until volatility suddenly exploded. So this time we've come full circle. Federal Reserve slashed interest rates to zero, which over many, many years reduced volatility. So by the end of 2015, the Federal Reserve slowly began lifting rates, then more quickly in 2017 and 2018. Now, even today, Federal Reserve still has interest rates at pretty high levels compared to, I think, what the economy can sustain in the U.S. And already we're starting to see this rise in volatility in the equity market. If I had to guess how this turns out, the equity market might continue to rise. It might have a last gigantic rally at the end of this year, 2020, maybe even into early 2021. But as that rally continues, the cost of options is likely to become more and more expensive, and it may look a great deal like the end of the 1990s. So if you look at the 1990s bull market, what you see is a bull market that really took place in two phases. From 1991 to 1996, volatility there in black fell, where the equity market was rising. Then in the second portion of the bull market, volatility rose and the equity market continued to soar anyway. And if you look at 1998, you can see that correction in the equity market that took place that year, about a 20% drop that sent volatility soaring. That's when the Fed cut rates and created this massive last rally that lasted for about a year and a half after those rate cuts. But during that rally, the market remained very, very volatile compared to how it had been, say, in 1993, 94, and 95. So it may not be that this equity bull market is over, but it may be that what's left of it becomes really, really wild and really unstable with bigger, more jagged upward moves and sharper, nastier corrections. During the next bull market, which took place from 2003 until 2008, we saw a very similar pattern. During this bull market, essentially for the first 4 years up until early 2007, volatility fell as equity prices soared. What was interesting here, too, is that volatility also hit bottom before the peak in the equity market. So volatility hit bottom in the early days of February 2007. And that was followed by a really big spike in volatility before the eventual peak in the market. And of course, once the market began to fall, volatility really, really started to soar, going as high as 80% implied vol on the S&P 500. So if you look at the current bull market, it's following a pattern very similar to what we saw, I think, in the 1990s and the most recent previous bull market in the 2000s. So basically from 2009 up until around the early days of 2018, volatility fell as equities soared, which is what one would expect. But since January 2018, equity volatility has been stepping higher. Each subsequent low is higher than the previous low. The upward spikes have gotten a little bit bigger, even as the equity market continues to soar onto new record highs. So the equity market prices are going higher, but options traders are basically charging more and more money for protection that this rally doesn't last. So options markets are clearly getting nervous. Likewise, if you look at the credit markets, this basically takes the same idea and just replacing the 2-year moving average of the VIX index of volatility with the 2-year moving average of credit spreads, essentially junk bond yields minus treasury yields. You see the same pattern. Basically, when you have a flat yield curve, that tends to eventually widen out credit spreads. Wider credit spreads cause a recession. That forces the central bank to ease policy. As the central bank eases policy, it steepens the yield curve, which eventually compresses credit spreads. So if you look at this time around, where we are today looks a lot like 2006. So 2006 was, of course, not the peak of the equity market. The equity market didn't peak until 2007. But credit spreads have begun to widen very, very slightly this time. It's not been a big widening yet, but I suspect that widening is on its way. So here too, equity markets seem to have two phases. In the 1990s, the first phase lasted from 1991 until maybe late 1997. During that phase, credit spreads narrowed and equities rose. That makes sense. You have junk bonds going higher in price, equities going higher in price. The second phase of the bull market started in 1998, where credit spreads began to widen, even as the stock market continued to soar. And so if you look at what happened in the next decade, also a similar story. Credit spreads narrowed from 2003 to 2007 as equities soared, but then well in advance of that equity market peak, about 8 months in advance, credit spreads began to widen. So if you look at what credit spreads are doing today, credit spreads are beginning to widen out a little bit. Credit spreads basically narrowed from 2009 until they got to their low about 14 months ago at the very beginning of October 2018. Since then, credit spreads have begun to widen out, even as the equity market has gone on to new record highs. Now, widening, I would add, is not very big yet. But if I had to guess how this turns out, I think credit spreads will start going a lot wider in 2020 and 2021. And if that's true, it may be that equities still have upside left, just as they did for 1998 and 1999, and just as they did for much of 2007. But I think that if you have to have one trade that might be interesting to look at, it would be to be long equities and somehow short junk bonds. Junk bonds, unlike stocks, don't have unlimited upside. The upside for a junk bond is basically, the coupon on the bond plus whatever little capital appreciation you can get if the yield falls further. So I think that this is a very, very interesting and very troubling trade. There is, of course, a relationship between credit spreads and volatility. So you saw how similar the VIX index and credit spreads look over time. The reason for that's very simple. It's that a junk bond or any corporate bond is basically like a U.S. Treasury plus a short put option on the value of the company. So if the markets become more volatile, option costs go higher. And if you're short an option, then that means you're further and further in the hole. So it implies that wider spreads can be caused by rising options prices. Another thing that concerns me a little bit here too is small cap stocks versus large caps. If you look at the S&P 500, which is the 500 biggest stocks in the U.S. stock market, versus the Russell 2000, which is 2,000 smaller companies. If you had invested in both indices in 1979, they would have delivered pretty similar performance. The Russell has only underperformed the S&P by a small amount over the last 40 years. But what's interesting is if you look at the ratio of these two indices, this is what you see. The ratio of the two indices basically shows that when the economy is in times of distress, like it was in the late 70s, the early 1990s, or for much of the decade from 2000 to 2009 or so, or 2010, small cap stocks tend to outperform. That may be because small cap companies don't have the same access to bond markets and bank funding as large cap stocks do. So when credit gets cut off, they maybe don't underperform so much because they don't rely so much on that kind of financing. It may also just be that small companies are more nimble. When the economy is navigating big changes, small companies can respond more quickly than big companies, which can be, turning around a big company can be sort of like turning around an oil tanker. Oil tankers, as I'm sure anybody has seen, they don't turn on a dime. They turn very, very slowly. By contrast, during the big equity bull markets of the 1980s and 1990s, it was really the large cap stocks that led the way. And since 2013, it's been the large caps who've been outperforming once again. They've outperformed by quite a lot since 2013. And of course, we saw at the beginning of the presentation, the Russell 2000 is the one index that's not trading at record highs. So if we see a rise in volatility, if we see wider credit spreads, in the short term, the equity market could still soar, but my guess is if we have life left in this bull market, it's going to concentrate probably in the biggest stocks, and smaller companies may wind up getting left behind like they did at the end of the 1980s and the end of the 1990s bull markets. But once a recession begins, which I think will begin at some point in the future, we don't know when, once the economy begins to turn downward, it would be time to switch out of the large caps and get back into the small caps, which tend to do better during recessions. As we mentioned at the beginning, the reason why the NASDAQ has done so much better is just that it involves so many technology companies. So if you look at IT and tech stocks, you really have to put them on a log chart to see how well they've done. But they've really been the market leaders during the current bull market, followed by consumer discretionary stocks and healthcare stocks, which have also done very, very well. Everything else is lagging pretty far behind, like telecom, utilities, materials, energy, financials. Nothing can quite match these three sectors that have dominated the market. But the dispersion between these sectors can also be a good indicator too. So what I do in the next chart is I look at these different, 9 different sectors of the market and look at their day-to-day correlation with the other sectors and then average it across the different sectors. And this is what you see. It's a very interesting pattern. So basically, in the early stages of bull markets, like at the beginning of the 1990s, the internal correlation is very high, which is to say that a rising tide lifts all boats at the beginning of an economic expansion. So basically, high internal correlations tend to be followed by very, very strong returns in the equity market. That was also true after 2009 for about 4 or 5 years. Extremely high correlation from 2009 till about 2014. Everything was going up together. On the other hand, correlations really broke down in a big way just before the equity bear market in 2000 to 2003. They broke down in a somewhat smaller way before 2007, and now we've seen another big breakdown of the internal correlation of the market. So this indicates to me the rally is becoming very, very narrow, very concentrated. That doesn't mean it can't continue. We've seen narrow rallies continue for long periods of time in the past. But I think, though, as the market continues to go upward, it's likely to become more and more narrowly concentrated in a few winning sectors, which involve, of course, large cap stocks, but also maybe favored industries that have a lot of momentum behind them. Things like consumer discretionary, healthcare, and technology stocks. And eventually, their stocks will become so overvalued relative to their earnings prospects that a correction will become inevitable, which, of course, will be very painful when that actually happens. If you look at earnings are also, of course, a key driver of equities. They also follow this very, very interesting pattern, not unlike what we saw with credit spreads and volatility. So earnings, for example, peaked in 2006, and they began a long decline that predated the eventual peak in the market in 2000. Likewise, earnings peaked again in 2006, and they were declining quite substantially before the market peaked in 2007. This time, earnings as a percentage of GDP peaked many, many years ago, and they've been falling pretty consistently. They're still at pretty high levels, but I think the trend for earnings is downward, really for a couple of reasons. First, global economic growth is slowing, which is not going to be good for corporate revenues. Secondly, labor markets are very tight, even though we haven't seen a lot of upward pressure on wages. Corporations are having a hard time getting workers in many, many fields. So that's probably going to put some downward pressure on their earnings. And then lastly, you have the fact of tighter interest rate policy in the U.S. Even though the Fed's cut 3 times, they've left 6 of their 9 rate increases in place. And that's raising the funding costs of companies. So if I had to guess, I think corporate earnings are going to continue to fall. As we've seen, that doesn't necessarily mean equities will peak imminently, but they will eventually peak and have to have a really nasty correction since they've maybe moved a little bit too far of where earnings can actually carry them. And then, of course, we have the question of, is the equity market itself overvalued? This is a notoriously difficult question to answer. If you look at the S&P 500's market cap as a percentage of GDP, you can see that it's actually extremely high. It's among the highest levels that we've ever seen, around 125, 130% of GDP market cap, which is basically taken back to where it was at the end of the 2000s, which of course was followed by first a 50% drop, then a recovery, then a 60% drop in the value of stocks. But of course, it's a more complicated story than that. Is the other factor to take into account is, what is the alternative to equities? And of course, the main alternative that most institutional investors have is fixed income. So logically, when fixed income yields are very, very low, as they were during the 1950s and 60s, and as they have been again recently, the market can, in theory, support very, very high levels of valuation. By contrast, when interest rates are extremely high, as they were during the 1970s and 80s, the market's valuation tends to be much, much lower. So on the one hand, we have a market that's trading in absolute terms at levels that are very expensive. On the other hand, the main alternative, fixed income, looks extremely unattractive. So if you take the blue line and you multiply it by the black line, it can give you some hint as to what's overvalued. So what's interesting is, in the late 60s and especially in the late 1990s and early 2000s, this indicator was giving a warning of an equity market bubble, that equities were way, way too high and they were susceptible to crashing. Whereas during the late 40s and throughout the 1950s, it gave the opposite indication, just as it has since 2007. It basically gives an indication that actually you're kind of in a bond bubble. And indeed, if you had been in bonds in, say, the 40s and 50s and held them for the next few decades, you would have gotten a really, really bad return on your bond investments going into the early 1980s. During that time, bond yields often were lower than inflation. So you actually would have lost money in real terms being in bonds. And the same thing has, of course, been true since the financial crisis. Bond yields are extremely low. And I would point out, of course, that bond yields in the U.S. are actually among the highest in the developed world. So compared to Europe or Japan, U.S. yields are actually very attractive, but they're barely higher than inflation. So basically, if you invest in bonds, the most you can really hope for is inflation. So you can look at the equity market and say, okay, well, it's getting overvalued. The valuation levels are very high. It's becoming very concentrated. Volatility is beginning to rise. Credit spreads are beginning to rise. There's a trade war. The economy is slowing down. All of those things should be bearish. And so that's true. On the other hand, there's no alternative to investing in equities that's very attractive for most investors. So it could be that even maybe the equity market is overvalued. It could just become more and more and more overvalued until one day bond yields start to rise and the equity market has a really violent, really brutal correction or bear market. So we think that's what makes this such a difficult market to trade. So we looked at this here, this relationship between interest rates and equities. Of course, it's also interesting to ask what's happening to interest rates and why. So what I think is really interesting in the interest rate markets is that we have seen this, how should we say, a sort of gap between average hourly earnings and productivity. That's developed over the last 4 decades or so, where productivity has climbed enormously. On this index, it was around 140 in 1980. Now it's doubled to 280. So basically, per hour worked, the average American produces about twice as much today as they did 40 years ago because of all those technological improvements, et cetera, and efficiency gains. On the other hand, if you look at people's earnings, what they actually take home after they have, gotten their paycheck, that has increased from about 120 to about 140. So basically, paychecks per hour adjusted for inflation are only 20% higher today than they were before. So not surprisingly, we have seen huge gains in inequality. Basically, the top 1% of the people who are mainly the owners of capital have seen their share of income go up very, very dramatically as productivity has soared, but workers' wages have stagnated. And this has really big implications, I think, for interest rate markets and for equities. So, of course, equities are also owned by the owners of capital, so they've done very, very well. They don't have to pay their workers so much, but they get giant productivity gains, so earnings have been very strong. Um, you know, Likewise, when you have this gap between productivity and earnings, the only way in which people can consume the output that they're generating is to borrow money. So essentially, the people at the top have been lending money to everybody else in order to finance their consumption. What I think is particularly disturbing here, as we saw, at the beginning of the presentation, is that there's been no deleveraging in the U.S. financial sector since 2008. So if you're wondering why it is U.S. interest rates have fallen so much since 1980, it's largely because debt levels have been rising. So as inequality rose and wages stagnated, this caused inflation to fall. Lower inflation meant lower interest rates, which meant increased borrowing. And increased borrowing, of course, forces the Federal Reserve to lower interest rates. So it's particularly fascinating. If you look at the early 1980s, the Fed got rates up to 20%. At the end of the 80s, they got them up to almost 10%. In 2000, they got them up to 6.5%. In 2006 and early 2007, they got it to 5.25%. This time, the Fed could only get rates at 2 3/8% before they had to start cutting. Why? Because debt levels are so incredibly high. And the only way that debt burden can be financed is through low interest rates. On the other hand, low interest rates also discount future earnings and dividends very slowly, which gives the equity market a very high valuation. And that's what I think makes politics so interesting right now. Essentially, we have now seen both left-wing and right-wing proposals for dealing with the burdens of debt that we see in the United States and the rising inequality. So essentially, President Trump's solution is to limit competition with other countries and hopefully, therefore, boost wages of lower income American workers, and also to decrease the amount of immigration, to limit the amount of immigration coming into the country in the hopes of also boosting workers' wages. From other candidates, like from Elizabeth Warren, we hear of very redistributionist policies. So those redistributionist policies basically involve increasing taxes on the wealthy in order to redistribute wealth. If either right-wing or left-wing or some combination of populist policies succeed in narrowing the income gap, so boosting wages faster than productivity, we could see inflation return, we could see debt levels fall, and those falling debt levels in turn could allow interest rates to rise. And that could be very, very bad for equity markets and very negative for fixed income markets, but potentially very positive for things like gold. Under President Trump, we've also seen an explosion of the U.S. budget deficit. Under his predecessor, under Barack Obama, the deficit went from over 10% of gross domestic product in 2009 down to just 2% of GDP by 2016. So far under President Trump, that deficit's risen to over 5% of gross domestic product. And I think this has really, really big implications for the U.S. dollar. Typically, when deficits are getting smaller, like they were during the 1990s, the U.S. dollar becomes a strong currency. When deficits become bigger, like they did in the early 2000s, really up until 2009, U.S. dollar tends to become a very weak currency. So again, under President Obama, deficits became much smaller. The dollar soared. Under President Trump, the deficits are getting much, much bigger. The U.S. dollar so far has not fallen a great deal, and I think it hasn't fallen a great deal in part because the Federal Reserve has been all by itself raising interest rates at a time when the European Central Bank, the Swiss National Bank, Bank of England, Bank of Japan, Reserve Bank of Australia, People's Bank of China were not raising rates. Now that the Fed is cutting rates, maybe we'll have to cut rates further. I think the U.S. dollar becomes a very, very weak currency. And I think that's phenomenally good news for gold. If I'm right and the dollar becomes a weak currency in the 1990s, that's going to be great, great news for the gold market. The gold market has also responded quite positively to the Fed cutting interest rates. Um, Now that the Fed seems to be done cutting interest rates for a while, the price of gold has kind of gone on hiatus for the moment. It's corrected a little bit, but I think its outcome really has a lot to do with the equity market. If equities wind up soaring onto new record highs, the Fed may have to raise interest rates again. In the short term, that will be really, really bad for gold. But if the Fed then subsequently over tightens policy and produces a recession like it did in, say, 2001, that'll be phenomenally good news for the gold market, because then you'll have the Fed cutting rates and the U.S. dollar sinking at the same time. So that lastly, we conclude by talking a little bit about the U.S. elections. If you look at the betting markets, like at Betfair or Predictit.org, or Ladbrokes or Paddy Power, or any of the other usual betting sites, they say President Trump has only about a 40% chance of being reelected. They think it's maybe a 53% chance or so that a Democrat gets elected, and maybe a 6% or so chance that a Republican other than Donald Trump gets elected next year. So the betting markets are basically saying it's going to be a very close election with a slight advantage to the Democrats. Now, if you look at history, however, when party control of the White House has changed, typically 4 years later, the incumbent party is reelected. Since 1896, about 125 years ago almost, only one time did a party fail to win a second term in office, and that's when President Carter lost to President Reagan in 1980. And of course, that election involved a deep economic recession, 13.5% inflation, the Iranian hostage crisis. They seized the U.S. Embassy, unfortunately for Mr. Carter, exactly 1 year to the day before the election. So it was November 4th, 1979. Americans were, if you will, celebrating that anniversary, November 4th, 1980, when Carter was not reelected. And of course, there was also the Soviet invasion of Afghanistan. Trump, of course, has his own problems. He has impeachment. But he does not have economic problems. The economy in the U.S. remains, from the perspective of most Americans, very, very strong. For the moment, the wind is at his back. And after 4 years, the incumbent party tends to have a 91% reelection rate. So the betting market say is a 40% chance of winning. This sort of naive view of him has a 91% chance of him winning. We'll see what happens. We obviously don't know. But I would say the probability of his reelection is probably not as high as 91%, but it may be considerably higher than 40%. So his real chance of being reelected may be more like 2/3. The last election produced really strong reactions among the various sectors of the U.S. equity market. So if you look at how they responded, they rose basically the most heavily regulated industries, financials, industrial stocks, energy, materials. All those stocks did very, very well in the aftermath of the election. The less concerned were healthcare, technology, etc. The fixed income markets also showed really strong reaction between the election and inauguration day. Bond yields rose across the curve, but especially at the long end of the curve. And of course, the U.S. election in 2016 also produced strong moves in currency markets, particularly bearish for the Mexican peso, because people were afraid of the subsequent renegotiation of NAFTA. Bad reaction with the Japanese yen, which was also concerned with trade tensions as well. The Russian ruble loved it. Apparently, they really liked Donald Trump in Russia, or at least he liked them. This time, if you look at how the markets have done subsequently, those initial reactions actually didn't have much bearing on how things turned out subsequently. For example, technology stocks kind of shrugged off the election, but now they're up 59% since inauguration day. Energy stocks initially were happy with the election, but they've actually fallen since Trump took power. Where financial stocks, industrials, materials have continued to go a bit higher. Utilities have done very well. Likewise, the yield curve actually steepened after Trump was reelected. Now we've had actually quite a large flattening of the yield curve. And of course, the currency markets, how they've actually performed under Trump is very different than their initial reactions. Like Mexico hasn't done so badly, but China and especially Brazil have done somewhat badly since he was elected. So I think that during the next election, the election that's coming up, the degree of market moves will vary a great deal depending on who the Democrats nominate. If they nominate a centrist candidate like Biden or Buttigieg or Michael Bloomberg, the market reactions may not be so strong. If they nominate a very hard left candidate like Elizabeth Warren or Bernie Sanders, I think the moves in the market could become much, much bigger, with much bigger equity sector rotations, much bigger currency moves. If Donald Trump is reelected, he may still have control of the Senate. He probably will not have control of the House of Representatives. So if he's reelected, you may not see a very strong market response unless maybe it's a very close election that's on a knife's edge. Because if he doesn't have control of Congress, he really won't be able to get much done outside of the area of trade and foreign policy. So that's it for our presentation. I'd be very happy to take a look at any questions you might have in our remaining time.
All right, do feel free to type in your questions into the question box. Meanwhile, Eric, we have two questions. I will read the first one to you. How do you view the shortage of cash will affect the equity market?
Right. So I think that's very interesting. I think it really goes back to the heart of what we saw with credit spreads. I think the problems that we saw in September in the repo market were sort of like the appetizer course for the upcoming credit crunch. And it reminds me a great deal of problems we saw in the credit markets in May 2006 and February 2007. They, at the time, got some media attention, some concern. Equities sold off briefly, but then people forgot about it. Equities continued to go higher. But I think that this is really very, very concerning because not only do we have the problem in the repo market in September where yields spiked as high as 10%, but in October we had the little discussed but very deep sell-off in the CLO market, this collateralized loan obligation market, which is basically sort of like structured products built on high yield bonds. That market did really badly last month too. And so all of this worries me that we're going to get into a more and more difficult credit environment. There'll be a lot of focus on the repo market in December. Repo refinancing needs are much higher at the end of the year than they are during the rest of the year. I think this time the Fed stands ready to provide a lot of liquidity, but I don't think that that's going to ultimately help the markets very much. It may prevent problems. In the next month, maybe we won't see repo yields going out to 7-10%. But I think ultimately the Fed has its rate policy much too tight, and we're still on the verge of a much, much bigger widening of credit spreads, which I think will happen next year.
All right, so for 2020, do you see a bullish trend for tech sector?
Well, I think the bullish trend is still in place at the moment. Whether it should be in place or not, and whether that sector is becoming overvalued is another matter. But yeah, I think that what I really want to stress is not that the bull market is going to come to an end quickly, but that as it continues, which I think it likely will continue for a while longer, I don't know if that's a month or two longer or a year or two longer, I think that it's going to become more and more volatile on the way up and more concentrated in the winning sectors. Now, technology is, of course, one of the winning sectors. It's one of the strong sectors of the market. So if the equity bull market continues, I think that technology large caps could do very, very well. That said, when you look at the technology sector, we're seeing more and more problems starting at the sort of small cap or IPO level, like we saw with WeWork, for example, and its sort of failed IPO. And so I think we're seeing a lot of problems bringing a lot of these venture capital companies to market. The venture capital space has been very crowded. I think there's way too much money chasing too few opportunities. And eventually, I think that money is going to leave the space. So there'll be less money available for venture capital funding, and that's going to hit companies like Intel. It's going to hit the microchip makers. And I think eventually people are even going to look at things like Apple and Google and Facebook and be like, okay, these are great companies, but no great company deserves an infinite market valuation. These companies still have to show a lot of earnings growth to justify their valuations. And then lastly, maybe most worrisome for technology is a sort of rise in global regulation. You're seeing a big move to regulate them in the European Union, a big move starting in the United States. It could be accentuated, especially if we have a Democratic victory in next year's presidential election. And so if they find themselves under heavier regulation, that could also be really negative for their stocks. So I think that in technology stocks, yes, we have an uptrend in place. That uptrend is very strong. It may continue for a while longer. But as it continues, expect more and more volatility and expect eventually, and I don't know when this is going to be, but expect eventually the market's going to become extremely concentrated and overvalued in that sector. And it's going to produce a brutal bear market afterwards.
All right. So, is there any reason to not be bullish on gold?
Yeah, I think the reason to not be bullish on gold is the possibility that the equity market could go into one last gigantic rally, which could force the Federal Reserve to, first force the market to abandon hope that the Fed's going to cut rates one more time, which is what it's priced. The market thinks there'll be one more rate cut, maybe around April next year. So if equities are, say, up another 20, 30%, that goes out the window. The Fed's not going to cut rates again in the short term if equities are soaring. And if equities continue to go higher and higher, the Fed may even reverse course and start raising rates, which is what they did in 1999 and 2000. And that was a difficult period for gold. Gold had fallen very low in 98. Then it had a rally during the Asian crisis, and it went back down, retested its lows. It's unbelievable that around $280 an ounce around 2001 as the Fed was just getting ready to cut rates. And it wasn't until the Fed really began slashing rates in 2001 and 2002 that gold finally really took off. So if the equity market has a gigantic rally, like it did at the end of the 1990s, that's going to be bad for gold in the short term. So I tend to be, as an investor, a gold accumulator. I hold it long term. I'm not really trying to trade it short term. But if I see gold prices falling in the equity market rally, I will personally, this is not a recommendation for anyone else, but I will personally continue to accumulate a bit more of it. Because I think eventually in the 2020s, the U.S. dollar becomes weak, the Fed goes back to zero rates, the equity market corrects. I think eventually you have a gigantic rally in gold. But putting an exact date on it is hard, and it may not be in the next few months.
All right, and our last question for today: What's your view of the emerging markets rather in 2020?
Yeah, I have a pretty bearish outlook, I would say, for emerging markets, and I think it really depends. I think the emerging markets are a very diverse group of companies. So countries. I would put them into two categories. The ones I'm most concerned about are the resource exporters. So any country like Brazil or Chile, or South Africa, that's exporting a great deal of raw materials. And I would put Russia in that category too. Countries that are exporting, especially industrial metals or energy, I think are going to be in a pretty tough way. And the reason for that is U.S. energy production continues to soar. There's a lot of supply of crude out there. And then secondly, industrial metal supplies are just off the charts. Since 1994, the supplies of things like aluminum and iron ore have tripled. The supply of copper is more than doubled. The world is awash in supply, and unless China can grow quickly enough to absorb that supply, those prices, I think, are going to crash. And when they crash, they're going to take a lot of these commodity exporting countries, currencies, and maybe equity markets down with them. On the other hand, the hope has always been that if China slows, India will pick up the pace. India's economy has also been slowing, which I think is pretty disturbing. India has a very tech-heavy equity market, so maybe the Sensex and the Nifty 50 continue to rally for a while. Difficult to say if the tech sector continues to do well. And then the other countries, like most emerging Asia, for example, it really depends, to my mind, how much they rely on exports to China or how much they compete with China. some of the smaller markets like Vietnam could actually do quite well as a result of the trade war, and their labor costs are still very low compared to China. So there's still a lot of productivity gains to be had in those countries. So I see the emerging markets as a diverse lot, but I'd be particularly skeptical of any natural resource exporting ones, especially on the currency side, but maybe on the equity side too.
All right, thank you so much, Eric, for your time and for your insightful presentation. Once again, thank you to our wonderful audience for tuning in to this very special session on the US indices. All right, till our next webinar, do look out for our follow-up email coming to you tomorrow. And rest assured, we have recorded this session so you can go through what we've covered today in the webinar recording. Once again, thank you for being a wonderful audience and good night. Thank you so much, Eric. Have a wonderful night as well.
Thank you. Bye.